Welcome to another video in our Taking Care of Business series. In Australia, there are four main business structures used, and in this video, we'll examine two of them: companies and trusts. You'll find the information in this video quite general because it's a complex area and it's almost impossible to provide advice on business structures without a clear understanding of your personal and business circumstances. For example, when deciding on the most appropriate business structure, you need to take into account such things as asset protection, tax minimisation, the admission of new partners or investors, compliance with all legal requirements, and capital gains tax consequences. In fact, quite often the choice of business structure will be a compromise based on the relative importance of each of these issues. A company or corporate structure is a separate legal entity distinct from its shareholders who own the company. Companies are granted their own legal status so as to be able to enter into contracts, and they can sue and be sued. They are governed by the Corporations Law, which is administered by the Australian Securities Investments Commission. There are different types of companies, but the most common form is a company limited by shares. These provide a form of asset protection with limited liability, so the personal assets of the individual shareholders are separated from any debts of the company. Companies lodge an annual tax return and their profits are taxed at a flat rate of 30%. Another type of business structure is a trust, which is not a separate legal entity like a company, but it appoints a trustee who is required to undertake all obligations and transactions on behalf of the trust, similar to an adult taking responsibility for a child. The trustee role carries a legal liability for the activities undertaken, so trustees are often companies to limit that liability. There are several types of trusts, including a discretionary trust, which is also called a family trust, where the trustee has the discretion on how the income of the trust is distributed each year. There is total flexibility in the distribution of the trust income, which in itself can provide substantial tax benefits. A unit trust, on the other hand, is a form of fixed trust, whereby each beneficiary or unit holder is entitled to a share of the trust income based on the number of units owned. A trust structure also provides a mechanism to pass family-owned assets to future generations. With a corporate trustee, a trust is also given some asset protection options. A trust must lodge a tax return and can pay tax in its own right if the net income is not fully distributed to its beneficiaries. So that's a really brief summary of how companies and trusts work. In another video, we examine sole traders and partnerships. But if you're looking to start your own business or want to restructure your existing operation, we urge you to consult with us regarding your choice of business structure. Until next time.